Hello, and thank you for attending Many Happy Returns, the last of AGR's series of 4 webinars on merchandise financial planning. For those of you who missed the other webinars, I'm Keith Dunn, the Principal Consultant for Buying and Merchandising here at AGR. I've worked in retailing for many years, during which time I've had senior buying and merchandising roles in a wide range of international businesses, including those whose logos you can now see on screen. Just a quick reminder about the other 3 webinars. The first looked at why robust merchandise financial planning is so important. The second covered stock planning and management. And the third examined how good markdown and discount planning can improve margins. All 3 webinars are available online. Please visit our website at agrdynamics.com for the links. In this webinar, I'll be looking at the challenges retailers face when planning their online business, in particular at the problems and maybe opportunities that are caused by customer returns. I'm going to start by looking at some of the underlying market data, which emphasises how COVID has changed the way customers shop, possibly forever, and which gives some pointers to the things that retailers are going to have to do to succeed in the new world. Moving on to returns, I'll discuss the effect that they have on the business and look at the legislation that makes returns management a necessity, not an option. We'll then examine the impact unsaleable returns or write-offs can have on margin. And finally, we'll look at how merchandise financial planning is affected by online, especially in relation to stock and intake planning. Before I carry on, can I just point out the Q&A button on your Teams bar? If you have any questions while we go through this webinar, please use this to ask them and we'll get back to you. Let's start with a bit of context. Back in 2020, the newspaper headlines were full of grim-faced politicians and predictions of the imminent collapse of the entire economy. Retail is dead, the commentators proclaimed, and for a while it really did look that way, with Debenhams, Arcadia, Oddbins, Harvest Furniture and many others going to the wall. But, as they say, from the ashes of disaster grow the roses of success, and by the start of 2021 we were seeing some remarkable results from other players in the sector. In January 21, a month where many retailers were reporting their worst ever performance because of the COVID-induced lockdown, the Cornish brand Sea Salt reported a 17% like-for-like growth. 17%! They achieved this because although sales in their physical stores dropped by 44%, online sales nearly doubled. At the same time, Amazon, who you might have thought couldn't get any bigger without sucking all the oxygen out of the room, reported that they were entering the golden age, having seen a 44% growth in sales in 2021 Q1. This scenario is repeated all over. The retailers that have succeeded are those with a strong, but more importantly, effective online presence. For every Arcadia, who never truly moved away from bricks and mortar, there's a Sea Salt. Retailers that have fully incorporated the internet into their business model. The fact is that an online presence is now the new normal for all retail sectors, including those that have traditionally only thrived in physical stores, such as horticulture and fresh food. And retailers are realising that to survive and thrive in future, their business models need to embrace the internet. So retail is dead. Long live retail. But what new challenges does this new world bring? Let's look at some of the numbers and research behind the growth of online. Just type online sales in COVID into Google and you'll get a long list of studies from organisations and think tanks such as the OECD, the Office of National Statistics and the UN Conference on Trade and Development, as well as a myriad of commercial surveys done by companies such as NatWest, Barclays and UPS. I've used this data to pull together some figures which demonstrate how retailing is changing. The full list of sources I've used are shown on this slide. On the previous slide, we saw some headline figures from a couple of retailers, but let's now look at the overall picture. While retail sales dropped dramatically, especially at the start of the lockdown in 2020, as you can see from this chart, they soon recovered, but not in physical stores. While physical, non-food stores saw sales drop 25% from 1919, online sales growth in the UK was 37% year on year. And this seems to be carrying on despite the gradual opening up of the economy. In January 21, for instance, most retail sectors saw their online businesses grow significantly. Health and beauty saw sales up 102% year on year. Beer and wine was 105% up, even with dry January. Electrical was up over 200%, and even clothing, which probably had the highest online penetration before the COVID crisis, was up by 22%, although this had fallen to 11% in March. In January 21, UK online sales accounted for a record 35.2% of all retailing, compared to the historical trend of around 19%. This dropped slightly to 33% by March, but this was still way above what had been the norm. Interestingly, it was the omni-channel retailers that were the biggest winners. These retailers saw sales almost double across their online channels compared to their online-only counterparts, who saw growth of less than a third. This disparity might be explained by customer preferences when it comes to returns, which we'll get to in a bit. Customer behaviour has also been changing. Since the pandemic began, nearly 50% of UK consumers bought a product online that they had previously only ever bought in store. They weren't just buying the traditional staples of clothing and books online, but well, everything. Importantly for retailers, 32% of these shoppers said that they expect to continue with their new e-commerce habits in the future, a figure that rises to 40% in 45 to 54-year-olds. To me, it looks like the internet customer is getting older. For retailers who are adjusting to the new world of online, the future looks rosy, but there's a big elephant in the room, and that's the problem of returns. Customer returns that occur following a sale in-store are around 10%. And any items that do come back can be processed and put on sale almost immediately. For online businesses, though, returns are a major factor, with a returns rate of 20% or more commonplace, and it's a lot more than that in some sectors. As an example, while we Brits splash out an average of £313 a year buying clothes online, we end up sending nearly half of them back. In fact, a third of shoppers that buy clothes online expect that the items will be unsuitable before they've even received them. The law on internet retailing is pretty clear. Retailers are obliged to accept returns of items that customers bought online and no longer want for whatever reason, and to give them a full refund. Online purchases are covered by the government's 2013 Consumer Contracts Regulations, which deal with distance selling. There are some exceptions, such as for perishable or personalised goods, but basically the law gives the customer 14 days to tell you that they want to return a product with no reason required, and another 14 days to return it. This could mean that it takes 28 days from the customer receiving the goods to you getting them back. Once you have the goods, you have another 14 days to give the customer a refund, and although by law you only need to refund in full if the goods are in their original packaging and haven't been used, in reality you aren't going to want to damage your reputation and get into too many disputes with customers, and full refunds tend to be the norm. What this means is that while setting up an online trading platform is relatively straightforward, e-commerce comes with a whole new set of logistics and stock planning challenges. Your distribution centre is no longer a place that just holds stock for replenishment to your stores, but the hub for fulfilment of online sales and the reprocessing of customer returns. As you can imagine, this isn't good news. 57% of retailers said that dealing with returns has a negative impact on the day-to-day running of their business. The returns and repairs process can account for 10% of the total supply chain costs, but can lead to a 30% reduction in profitability. And poor returns management processes can result in the need to buy new stock, even though resellable stock is actually in the system. The growth in online sales, together with the legislation that obliges the retailer to accept them, means that returns are a big problem, a £7 billion problem in fact, since that's the estimated value of goods returned in 2020. And it's rising by more than 20% a year. More importantly, as far as the business model is concerned, customer surveys show that the ability to return a product bought online, either by post or courier, or back to a store, and how easy it is to do this is a key factor in deciding whether to make a purchase. Here's some more facts. 61% of shoppers consider the ability to return online purchases to a store an important part of the buying decision, which probably accounts for the growth in omnichannel retailing compared to online-only operators. And 50% of potential customers abandon the purchase due to lack of returns channels. 20% of people will only shop with retailers that offer free returns. 19% order multiple versions of the same item so that they can make up their mind when it's been delivered. 30% of shoppers deliberately overpurchase, based on the assumption that they won't actually like what they've ordered when they get it. 50% are concerned about the environmental impact of online purchases, although only 10% factor this into their shopping habits. Overall, it's estimated that 56% of potential customers were lost due to returns policies. As many wiser men are saying, if you don't sort out your returns policy and put the infrastructure into place to deliver it, then you're going to lose customers. In practical terms, what happens with online sales is that you dispatch a number of items to the customers each week. These are your gross sales, and expect to receive a certain proportion of these items back. This proportion is the returns rate, and you should be able to establish what it is for each product category by analysis of past returns. Your net sales, in other words, the goods that the customers have held on to, are equal to gross sales less returns. Unfortunately, for planning purposes, the returns rate won't always be constant, and it's likely to rise after a product has been marked down. Today's return is tomorrow's dispatch, and the most important thing for the retailer to do is to get the returned goods ready for resale as quickly as possible. And this is a real pain, since the goods have to be thoroughly checked and possibly repackaged before they can be recycled back into stock. This obviously takes time and resources, which will inevitably affect the bottom line. But even if everything is returned in good condition and can be recycled to stock quickly, there is still the problem of lag. As we've seen, simply applying the existing law means that you're obliged to accept all returns up to 4 weeks after they've been received by the customer. And many retailers have extended returns windows. The problem here is that the customers aren't going to return goods at the same time. And even with the minimum 28 days, this can cause problems. Goods are going to trickle back, and predicting exactly how much stock you will have available for resale is tricky. It's also possible that by the time something that was sold at full price is sent back to you, it's already been marked down. Let's look at an example. Let's say you have a returns rate of 20%. If gross sales or dispatches in a week are 100, therefore, you can expect to get 20 of these back. But these returns won't come back into the business at the same time. For example, let's assume that you get 10% back in the first week, 40% in week 2, 30% in week 3, and 20% in week 4. The last return from the dispatches made in week 1, therefore, will arrive back in your DC in week 4, and so on. What this means is that it's quite possible that you will continue to receive returns after the product has stopped selling, meaning that the net sales at that point are going to be negative. Likewise, returns create an additional headache for the DC after a product has been marked down for clearance, since they're going to be getting back products that were sold at a different price to the price when the return is received, which means that they're going to need to be repriced before they can be resold. If a product's on sale at full price for 8 weeks, for example, and it's taken off sale in the 13th week, then you'd get something like this, with the final 3 weeks of net sale being negative. The blue highlights show the full price items that will be returned after the product has been marked down. In reality, you wouldn't stop selling the product after 12 weeks, but you get the idea. In the last example, we assumed that all the goods that were returned were resaleable, but in reality that's not going to happen. Some of the stock you get back is going to be damaged and will need to be written off or repaired. And don't forget that there's also likely to be some residual stock that will also need to be written off, which also needs to be factored into the calculation. The cost value of every item that you write off is a straight loss of margin. But there's also the impact on potential sales, because the stock that's written off is no longer available to sell. It's a bit tricky to model the effect of write-offs, but I'll try using our example product again. The original selling price is £20 excluding VAT, and the cost price is £7. I've assumed the product will sell 600 units at full price, and then modelled potential markdown sales to give an expected sales value. Write-offs are set at 20% of the returned units. As you can see, with no write-offs, margin is just over 8,000. But as soon as you factor write-offs in, this falls by 4%. This is due not only to the cost of the write-offs, but also because sales overall are lower due to having less stock to sell. While this is obviously a hypothetical example, it won't be too far off reality, and I hope that it demonstrates why it's so important to build write-offs into your plans. Before we look at how to plan for returns in MFP, let's take a quick look at stock planning for online. In our second webinar, still available online if you want to check it out, we looked at how stock is your biggest cost and why effective stock control is so important. And I'm going to revisit one of the key principles we discussed here. The starting point for good stock control is to determine how much stock you actually need to hold. The optimum is to hold enough stock to satisfy customer demand without risk. Risk in this case being a lost sale. So how much stock is that? The key metric is the week's cover that you're holding at any time. Week's cover is the ratio of stock to sales. And among other things, it tells you what the multiple is that your sales for a week would have to increase before you run out of stock. If you're holding 4 units of stock, and on average you sell 1 unit a week, for instance, you're holding 4 weeks cover. And you need to sell 4 times as much as normal to sell out of stock in that week. Is that ever going to happen? So if you sell 1 unit as normal, then you've got 3 units left. In other words, more than enough to cover 3 more weeks of normal sales before the stock was replenished. Even if you sell twice as many units as normal, you'd still have 2 units left, which represent another 2 weeks of normal sales. The thing to ask yourself when setting your stock targets, therefore, is, do you really expect sales to be twice what is normal in any given week? If the answer to that is no, then a stock holding a 4 weeks cover is more than enough to make the risk of losing a sale very low. This argument is especially pertinent for online operations, where you don't have to service physical stores and there's no need to hold a minimum level of stock just to maintain the in-store display. As a result, online retailers should, in principle at least, be able to keep stock levels much tighter, and there really aren't any reasons to hold more stock than strictly necessary. Whether you can do this is largely dependent on your supply chain, but the benefits in terms of cash flow and warehouse efficiencies are huge. Let's look at our example product and see what happens to weeks cover if we bring the whole buying in one hit. As you can see, during the first 8 weeks, when the product is selling at full price, cover never drops below 5 weeks, and is far too high most of the time. If you are able to bring the product in 3 hits, on the other hand, the weeks cover falls dramatically, but there still aren't any weeks when there's a significant risk of losing sales. You would need to decide what was right for you given your own supply chain, but I hope you'd agree that this is definitely something you need to think about when you set your stock plans. As I emphasised in the previous webinars, using a connected, robust planning process in conjunction with a well-engineered system will enable you to set realistic and achievable plans. I'm going to demonstrate the way returns are incorporated into the planning process using AGR's Merchandise Financial Planning module, which gives you all the tools you need to plan sales, stock, intake and margins for both online and physical outlets. As far as merchandise financial planning is concerned, returns and write-offs are just 2 more metrics that need to be included. As always, analysis of historical data will help you to establish what the appropriate returns and write-off rates are, so that you can ensure that their impact is minimised. The planning process for online isn't significantly different to that for bricks and mortar. Plan sales, margin and promotions, set your stock targets and amend the intake as required. And finally, review and amend margins and sales volumes before you fix the plans. The main difference is that you now need to take returns and write-offs into consideration. As always, you need to start with a robust sales plan that's based on thorough examination of the available facts. The difference is that you're going to plan gross sales and returns. Net sales is just the difference between the two. As with any other data in AGR, these values will be seeded from the last year actuals and can be amended as required at any level of the planning hierarchy. Markdowns are planned as normal into the weeks in which the clearance events will be taking place, but with online you'll need to plan markdowns in for every week following the first reduction to allow for the repricing that is needed because of the returns lag. Likewise, markdowns may continue to be needed after a product's been classified as old stock, as you try to clear down as much of the residue as possible. The rules for setting the markdown plan for online are the same as we covered in the last webinar. It needs to be set at a level that reflects the achievable sell-through and average depth of markdown that's needed to clear down the stock. But note that with online, the average depth of markdown is likely to be much higher because of returns. Discount planning is no different to that for physical stores, but you will need to make sure that your ERP captures the actual price paid by the customer in order to process any refunds. With regards to stock planning, as we discussed earlier, there's no reason why you need to hold a huge amount of stock to service online sales, providing you do have a supportive supply chain, of course. As you can see here, a forward cover of 4 weeks gives you more than enough headroom in the weekly cover to prevent any risk of missing sales. With stock and intake planning for online, you need to plan in the write-offs. Again, in AGR, these will be populated automatically, either by using last year's values or the configuration settings, and can be amended as required. The intake calculations are slightly different where online is concerned. since you need to know what the true open to buy is going to be after returns and write-offs have been factored in, and so that you only buy what you're actually going to sell. In this example, the gross intake for the week, in other words, the total value of goods received at the DC, is £29.59. To get the net intake, you subtract returns and add back in the write-offs. So £29.59 minus £7.64 plus £1.71 gives you £23.46. Returns also mean, as you can see here, that there can be weeks where there's no requirement for any new intake, and the only intake received at the DC are the returns. The final step before fixing the plans is to review the sales volume and margin on sales that will be delivered, and to make adjustments to discounts, markdowns, etc. as required. In AGR, all value forecasts are immediately converted to units and cost using rolling average cost and selling prices that give a high degree of accuracy and mean that margins are automatically updated when markdowns or promotions are amended or new intake is received. One of the features in AGR that's really useful where margin planning is concerned is the ability to save multiple scenarios, which allows you to create best case, worst case scenarios and retrieve them as required. And that brings us to the end of our final webinar. I hope it's made you think about why you need to build returns into your merchandise financial planning process and given you some ideas on how to do it. The fact is, online retailing has become the new normal, and successful retailers will be those that can respond to its challenges. The main challenge is managing returns, and while every retailer has different returns policies, the law is very clear. You have to deal with them. As such, in order to ensure that stocks and intake are effectively controlled and that margin forecasts are accurate, return and write-off planning needs to be an integral part of your financial planning model. Of course, if you're looking for the right tools to plan and manage your online business, then AGR's Merchandise Financial Planning module provides you with everything that you need and has the flexibility to build in any specific metrics that you might require. To find out more about the module or to book a demo, please contact us on info@agrdynamics.com. And don't forget to visit our website to download the earlier webinars if you've not already seen them.
Thank you, Keith. This was very informative. We will stay online now for a couple of minutes to answer any questions that come via the Q&A sidebar. And don't forget that you can send in questions anonymously if you prefer. We actually did get some questions during the webinar that I want to go over now. And I wanted to start by going through the first one. The question is, can the system predict what the future return rate will be? The answer to this question is yes, it actually can, but providing that we have the returns history in your data. The next question that we got is that how long does it typically take to implement the solution? You're going to be looking at a minimum of 15 days, but this, of course, will depend on the state of the data and on any customization requirements that you might actually have. We want to give you a couple of minutes to see if there are any more questions that will come in. So feel free to send in any questions that you have. We'll be waiting on the line for just a couple of more minutes. I see that we've gotten an extra question. Can the system be used straight out of the box? It's actually a very good question. My colleagues are taking a minute to answer, so let's just stay on the line for just a minute. So the answer to the question, can the system be used straight out of the box? The system comes with a set of standard workspaces that support a typical planning process, and you can easily configure them to your own needs. And of course, we give full training support. We found that because it's very much an Excel replacement, that user adoption tends to be very quick. So it doesn't seem that we don't have any more questions as of now. So I think we will just be wrapping it up. If you have any further questions or anything that comes to mind, feel free to send us an email to info@hgrdynamics.com, and we'll just get back to you. So until next time, everybody, take care and have a great day. Bye-bye.